Good morning, everyone. Welcome to the Stock Market Morning Prep video for Friday, April the 11th. Red across the board, continually selling pretty much most of the day. Dow Jones down 266, NASDAQ 129 down 3.1%, S&P down 39, and Russell down 32. Just a real ugly day, guys. I mean, literally everything got taken to the woodshed. And remember, we spoke about this. I mentioned when retail are buying stocks on margin, meaning borrowed money from the broker-dealer, and they're caught. There's a lot of retail caught up here. What's going to happen is they're going to sell everything. They're going to liquidate. They're going to sell first and ask questions later, and everything gets taken to the woodshed. Now, remember, what's rallied today? Gold, bonds, and the yen. And what is that? It's risk aversion. And utilities holding in there. REITs are holding in there, consumer discretionary holding in there, high yields, anything to do that's producing a dividend, that's where they're parking their money, and bonds. I'm telling you, we have to really be cautious here because I think that we can really start getting momentum to the downside. If you haven't seen my video from Saturday, please go into the YouTube channel and take a look at it. Gives you a good idea of what I was thinking over the weekend. And I even realized yesterday's bounce up, and I looked at them like there's nothing really new here. There's nothing to really warrant this rally. But again, it doesn't matter what I think, right? It's what price action is telling us, and that's what we want to solidify, right? That's, as traders, we want to say, okay, doesn't matter what I think. Price is moving higher, and if you're a day trader, you're looking for to buy pullbacks, and you're going to stick with the trend, vice versa to the downside. Okay. Now, I'm going to be looking at some indices, and I want to look at some of the indicators because I want to know when we might be ready for a snapback rally, some sort of a short covering rally, right? We had an outside day reversal today, so it's a nasty day. We have done some technical damage, but we're still holding in there. The longer term picture still remains intact, and really this is healthy for the markets to digest, to kind of unwind some of that overbought reading, to really start taking, some of these stocks to a little bit more reality. I mean, some of these stocks have actually doubled and tripled in the last year, and really it's just, when you have a fairly valued market, there's really no reason to buy stocks unless you're just trading them. And that's what happens. We have retail come in, they buy, and then sure enough, they buy the dip, they get hurt. They buy the dip, they get hurt. Now they buy the dip, and then that's it. And then they sell at the top, they sell at the lows, and then the market reverts and takes all the weak hands out. So remember that. Just keep that in mind. All right, so let's go look at, get some clues. We have the McClellan oscillator here. Plenty of room to the downside. So should we be picking a bottom? Absolutely not. But when we get extremely overbought, you can literally, you're safe to say, easy to manage to go and look to buy. But right now, that's not the point. The point is that we have plenty of room to the downside, okay? Take a look at stocks above the 50-day moving average. We just hit the 50 percentile. We have plenty of room to run to the downside, okay? That's another thing. VIX. VIX up 14% today. And guess what? We have the Bollinger Band starting to tighten and plenty of room to run before we get extremely overbought in the VIX, okay? So that tells me that the markets are vulnerable to the downside. And we had 2 days up, and we took it all back with an outside day reversal. I'm going to show that to you in the chart segment, okay? Now, let's take a look at the XLY, XL pizza ratio. Okay, it's consumer discretionary versus the consumer staples. What's happening? Money is flowing out of consumer discretionary like it should, right? And it's hiding in consumer staples, utilities, any high-yielding stocks, ETFs, REITs, and bonds, and the yen. And when they start to move versus what the market does, money is rotating out of certain sectors. The growth, like I mentioned yesterday morning, growth is getting sold and value is being bid up, okay? And that's what we want to look for. So you as a trader, as an investor, you want to see where the money's flowing and start parking your money there until the storm passes, all right? So keep an eye on that. Now, here's what's interesting, and I mentioned this yesterday morning. Here's the dollar, the U.S. dollar. Look at this huge support area. If the dollar breaks now, and today I was actually surprised. Well, I shouldn't say surprised, but I was surprised in the price action this past week when last week we had on Friday, we had the non-farm payroll numbers come out and they smashed them. Usually the dollar is a flight to safety as well, and apparently this is not the case. So if the dollar breaks down, okay, and really starts to break down, and you get a yen rising, you're going to have some good opportunity in the obviously the currency pairs. Number one, number two, in commodities, right? When the dollar breaks down, commodities get bid up, and I mean literally across the board. Soft commodities, you could talk about the beans, grains, hard commodities such as copper, platinum, palladium, gold, obviously, and then of course crude oil. And that's something that I really like, is the crude oil setup. I do think in the longer term picture, if you look at the monthly chart of gold, gold is still in a bear market. Don't let anybody say that gold is back in a bull market. Right now, it's below the 8 and 21 month moving average. It is still in a bear market, just literally back testing. So we could still play that on the shorter term time frame charts to take advantage of it. But as of right now, bonds are getting bid up, gold is getting bid up, crude oil is getting bid up, all of the commodities, because you see here, you see the dollar breaking down, okay? So watch the 79 area. If we do in fact break down, and we break down hard, I mean separate, not just break down and then pop up, because we could do that here and we could do that here. If it starts to really break down, it gives us a trend moving lower, because you can see this head and shoulders pattern here is actually holding true. Then we could literally start picking up some commodity plays and hold them going into the spring. All right, so that's another thing that I wanted. Let's go right into the indices. Bonds, ZB. All right, the 30-year, bond future. Now, as you can see, it has broken above this area of resistance, which will now act as support. Now, it's not that far away from it, but if we can really break out, the next back test, you could actually go into bonds and you could play the TLT ETF, and that, I would say, go out of the money into maybe May, June, and then pick up maybe a Delta 20, Delta 40 option in that sector, in that ETF, and look at the volume on this thing. This is actually scary if you're a bull, because money is now rotating back. Many technicians I've seen and heard that, oh, bonds is now broken down, and we're going to see a bigger move to the downside, and that may happen. You know, you really don't know, right? You grab the information from the chart and you apply that to your technical analysis, and then you apply that to your trading, right? So right now, this tells me that we're moving higher. Until proven guilty, I'm looking at bonds to move higher, and I'm looking at U.S. equities to move lower, and that was one of my analysis over the weekend. Let's take a look at the yen. Same thing. We have now recaptured this ascending triangle, and we have a cluster. We have a fib cluster here, but if we start to break out of this cluster, the next really big fib cluster comes in right up around here, and if that happens, if the yen gets back up to this area, you're going to have a massive liquidation in equities. Now, I'm not saying that a market crash. I'm just saying that we'd have a sidestep lower, a little pop up and lower, and you'll have weakness coming in to U.S. equities. Okay, that's the yen. Now let's take a look at some of these. Indices. Now here's the ES 1 hour, 1820 basically held for today. But if we break 1820, 790, 1798, 1800 is going to be your next big area. You're going to have that round lot area too, that psychological area of support. But we start breaking that. We do have a lot of support down below. But remember, once the train goes and we start moving lower, we start making lower lows and lower highs, it's going to be very, very hard to revert back up, because you don't have a catalyst anymore. Okay, now it looks like to me, what looks like is that I think the smart money is realizing that the Fed is really and putting it in a nice way, that the Fed is really creating more problems than what it should be doing. Okay, you have Janet Yellen, an ultra dove, I mean a super dove, and not looking at what the ramifications are for keeping this market where it is elevated and interest rates extremely low. So you have to realize that. And the problem is that rates are rising, and they're not going to be kept low by the Fed anymore. And when that happens, they're going to be stuck in a corner. Okay, and that's going to be a big problem down the road. And I think the smart money's starting to realize that. Let's take a look at the transports, the IYT ETF. Now, long-term uptrend line still intact, right? This is major. If it breaks this area, you need to pay attention to this, because if the transports go, so goes the market. Okay, and also we have other sectors which I'll point out in a minute after I get through the indices. You could see here 130, 128 is going to be your next area. If we break that and we start separating that, then you got the 200, and below the 200, You have mutual funds, pension funds, and money managers all look at it. If we're above the 200, they buy pullbacks. If it's below, they start selling and reducing their portfolio. Okay, so that's going to be another factor. Now, we're way away from that for now, but not so far from the Qs. Look at the Qs. That is the NASDAQ. Outside day reversal, huge outside day. As you can see, pattern recognition remains intact. We're breaking down here. We have outside day reversals on all the indices making lower lows and lower highs. Okay, we have this this downtrend channel here. Just going to put that in there. And now this is going to be the next big area at 84. Below that is 83. And if we lose that 200, I think it's going to add more fuel to the fire by putting more pressure on stocks to the downside. Okay, now the Qs have been literally battered, been decimated. And here's the IWM. And I want to show this to you here. We have two trend lines, okay? We have broken down through one. Now, the IWM is the Russell, another one of our major leaders. Now, this comes way back here from 2012, November 2012 lows. The one from back in November has been breached, okay? Now, this one here is still intact. Actually, it was breached, but now it actually closed right at it. If we lose this, this is going to be another pressure to the downside in equities, okay? So we really have to understand that the markets are in trouble here. Let's just take one more, the euro dollar. And the reason why I like the euro dollar is why when you have the dollar down, the euro dollar starting to rise. This to me looks like it's going to the 1272 extension. If it breaks, the next pullback should be bought if you are trading some currencies. Currencies are starting to move, but also if you look at the DAX, the German DAX, it's the leader of Europe, right? It's breaking down as well. So we really need to be cognizant of what's happening and in our surroundings. We don't want to be stuck and just focused on one thing. Remember, guys, the markets are vulnerable here, and when you have that eager and willing sellers coming in and pushing this market down, you know, you have to really be careful here. Now, last point I want to make, and I mentioned it before, is that we don't want to short in the hole too, right? Let the market do its thing. If you missed it, so be it. You will have some violent snapback rallies, retracement rallies, because you will just, that's just what's going to be. You'll have them. You don't want to get short in the hole. Let the market digest. Let the market pop up. And then the next lower high, I think that we can really start getting aggressive to the downside. Remember, the markets are still, it's only one day. We had a day down. Remember a few days ago, we had 2 days up. And now we have a day down. Friday's going to be really interesting, to say the least. We're going to have a weekend. Do people want to reduce their exposure? You know, generally on Fridays, coming the spring, summer months is usually bullish. But this might be a game changer. Let's see what happens for tomorrow, okay? Have your stops in place. Be careful out there. And we will speak to you on Monday with a big report.